Assalamualaikum. Hello everyone. Hope you all are doing well. Today I'm here with another topic of economics. Firstly, let's recall the general overview of economics. Economics is the social science that is concerned with production, distribution and consumption of goods and services. And you all know that goods and services are all those things which we can utilize to fulfill our basic needs. So today our topic is the concept of national income. In today's lecture we will learn about the national income. The word national income has its own meaning. National means you talk about the country's aspects and national income means country's income. So in economics, national income means the value of goods and services produced by a country during a year. Thus it is the net result of all economic activities of any country during a period of 1 year and is valued in terms of money. In the very first lecture, I discussed about different well-known economists. Alfred Marshall is one of them. Different economists have their own definitions of national income. According to Alfred Marshall, aggregate of goods and services produced by utilizing the natural resources and capital in a country in a fixed period of time, which is generally a year, is known as national income. In this definition, he wants to explain that the individuals of a country produce a certain amount of goods and services which are known as national income. Goods mean production of agricultural crops, manufactured items, minerals, forest, livestock, etc. And the institutions which provide services like business, banks, means of transportation and communication, etc. And moreover, individuals who do not produce goods but provide services are also included in the national income, such as services of teachers, doctors, lawyers, judges, etc. It means that the aggregate of all the goods and services produced in a year in the economy is called national income. Now let's discuss the different concepts of national income. The important concepts of national income are: number 1, gross national product GNP, net national product NNP, gross domestic product GDP. Let's discuss them one by one in detail. Here is the first concept of national income, which is gross national product, and it also denoted as GNP. The aggregate of all the goods and services produced in a country during a year is known as gross national product. It is the proper definition of GNP. It includes agriculture products, industrial and mineral products, and the production of other sectors of the economy. Similarly, the income of different people who provide services like doctors, teachers, lawyers and government officers are also added. Moreover, the income profit of services providing institutions like insurance companies, banks, shipping companies, means of transportation and communication are also included in gross national product. In economics, we describe every topic with graph and a mathematical representation. So here's the equation of GNP. Gross national product is equal to consumption plus investment plus public expenditure and investment plus export minus imports. GNP is equal to C plus I plus G plus into X minus M. X for exports and M for imports. X minus M, the difference between the value of exports and value of imports, is also included in GNP. Surplus balance of trade means the value of export is greater than the value of imports, and the foreign exchange earning on export surplus becomes a part of GNP. Here is the another concept of national income, which is net national product, and it also denoted as NNP. If the depreciation allowance or wear and tear expenses on capital goods, machines are deducted from gross national product, we get net national product. For example, A farmer purchases a tractor at a cost of 3 lakh. Say the lifespan of the tractor is 20 years. If the farmer set aside 15,000 rupees per year for 20 years for the replacement of the tractor, he will be able to purchase a new one when his present tractor is worn out in 20 years. Depreciation is considered very important in the concept of national income because when we keep in the mind of depreciation, the capital remains intact and is not wasted. Here is the equation of NNP. Net national product is equal to gross national product minus depreciation allowance. NNP is equal to GNP minus depreciation allowance. Depreciation means the wear and tear expenses on machines, vehicles and other capital equipments. Here is the another concept of national income, which is gross domestic product, and it also denoted it as GDP. It's a very important topic of economics and it also a very important part of country's income and its growth. It is the market value of all goods and services produced during a year with the help of internal resources of the country. Different sectors of economy need inputs to produce goods and services output. This output is also called gross domestic product. GDP provides an economic snapshot of a country used to estimate the size of an economy and its growth rate. It can be calculated in 3 ways: using expenditure, production or incomes, and it can be adjusted for inflation and population to provide deeper insights. GDP is a key tool to guide policymakers, investors and businesses in strategic decision making. Here is the equation of GDP. Gross domestic product is equal to gross national product minus income from external sources. GDP is equal to GNP minus income from external sources, and external sources are like gifts. Alright, so this can be explained with the help of facts and figures of Pakistan economy. According to 2011 to 12 data, GNP of Pakistan at factor cost was rupees 6,263,187 million, while income from external sources was rupees 2,346,116 million. So the GDP at the factor cost was rupees 60,28571 million. Here is the little overview of GDP rate from 2017 to 2021. It's basically the conclusion of these years. 2017 to 2018 there is an increase. In 2018 GDP will be declining. In 2019 GDP also declining, and in 2020 it shows the increasing rate of GDP.
A country's gross national income, or its GNI, is the sum of all goods and services it produces, plus net income received from other countries. It's closely related to gross domestic product, or GDP, which is the monetary value of all goods and services a country produces. But GNI adds the net income a country receives from overseas. That income includes the net on compensation, property income, and taxes on production and imports. GNI is the total amount a country actually gets to keep. For example, when an American-owned company operating in Canada sends its profits back to the United States, the US's GNI grows. And if a Canadian company operating within the US sends its profits back to Canada, those profits will count toward Canada's GNI, but not the US's. The GNI is quite similar to a country's gross national product, GNP, which counts output from its citizens and companies regardless of where they are located. Usually, a nation's GNI and GDP are close, since the difference between what a nation receives from abroad negates most of what it pays overseas. But if the profit outflows from foreign countries located within a nation's borders far exceed the inflows of overseas income, a nation's GNI can fall far below GDP. For example, Ireland's GNI was 20% below its GDP in 2011 because the foreign investors it welcomed sent a large chunk of their profits back home. In this case, GNI was a better gauge of what its economy was actually producing. A higher GNI bodes well for a country.
Let's preview the lecture. In today's lecture, we learned about the concept of national income. According to Alfred Marshall, different concepts of national income, GNP, NNP, GDP. Hope now you have a better understanding about all these concepts. Thank you for being here. Thank you for listening the lecture. Take care of yourself, take care of everyone around you. Like the video, share it, and subscribe the channel if you want to know about the other topics and videos about economics. Thank you. Allah Hafiz.